everyone, welcome back to ASC Group. I am Sara Verma,
And I'm Manish Rai.
and today we'll be discussing about the proposed changes with respect to charitable trust or institutions introduced in Finance Act 2023.
In general, trusts are created by philanthropic individuals and institutions for the welfare of the people. The government should encourage the formation of such trust as long as they are following norms set by the law in rendering the services.
But in the recent past years, trusts are put to greater difficulty right from the formation to claiming exemptions and so on. One can say that the taxation of charitable institution has been under scanner in recent times, and government has brought in various amendments in the relevant provision governing the taxation of charitable institutions. Let's deep dive into the provisions proposed in the recent budget one by one. Income of any fund or institution under Section 1023C or any trust or institution registered under Section 12AA or 12AB is exempt, but upon fulfillment of certain conditions. The exemption to the trust or institution is available under the two regimes. Number one, regime for any fund or trust or institution under Section 1023C, which is referred as the first regime, and the regime for the trust registered under Section 12AA or 12AB, which is referred as the second regime.
So basically, the first amendment proposed is related to the corpus donation or the repayment of loans or borrowings. Presently, if any trust seeks to get exemption of corpus donation, then the same needs to be invested in the mode specified under Section 11, subsection 5 of the Act, such as investment in savings certificate, deposit with IDBI, then immovable investments in immovable property, etc. Further, application made out of corpus shall not be considered as application for charitable or religious purposes. However, when such amount is reinvested or deposited back in the mode specified under Section 11, subsection 5 of the Act, such amount is allowed as an application in the year in which it is deposited. And similarly, in the case of loans and borrowings, if the application is made out of loans and borrowings, the amount shall not be considered as for charitable or religious purposes. However, if the repayment is made from the income of the previous year, then such amount shall be allowed as an application in the year of repayment. This was introduced by Finance Act 2021.
Furthermore, general conditions to claim application is also required to be satisfied in case if the application is made out of corpus or loans or borrowings, and these conditions are as follows. Number one, such application should not be in the form of corpus donation to any another trust. Number two, TDS if applicable should be deducted on such application. Number three, application whereby payment or aggregate of payment exceeds rupees 10,000 to a person in a day in any other than specified mode such as cash mode is not allowed. Number four, set off and carry forward of excess application is not allowed. Number fifth, application is only allowed in the year in which it is actually paid. Number six, application should not benefit any person directly or indirectly, which is referred in the Section 13, subsection 1 of the Income Tax Act, or income of any trust or institution should not ensure any benefit to such person. And the last one, application should be in India. While implementing the changes introduced by Finance Act 2021, it came to the notice that the application out of corpus or loan or borrowings have already been claimed as application prior to 1st April 2021. However, allowing such amount as application again as an investment or reposting back to the corpus or a payment of loan or borrowing will amount to double deduction. Furthermore, availability of the indefinite period for the investment or depositing back to the corpus or repayment of loan and borrowing will make the implementation of the provisions quite difficult.
Thus, in Finance Act 2023, the provision is amended. Now, any application made by the charitable trust or religious trust made out of the corpus or loans or borrowings, then such amount shall be allowed only when such amount is reinvested or deposited back into the corpus or loans and borrowings are repaid within the 5 years. Further, it is also proposed to provide that the application made out of corpus or loans and borrowings before 1st April 2021 shall not be allowed as an application for charitable or religious purposes when such amount is invested or deposited back into the corpus or loans and borrowings are repaid. This shall be applicable from 1st April 2023.
Now moving forward to our second amendment, which is related to the treatment of donation to other trusts. Since we all know that the income of the trust or institution under both regimes is exempt, but upon fulfillment of certain conditions. Currently, 85% of the trust or institution should be applied for the charitable or religious purposes, either by themselves or by donating it to any other trust with the similar objectives. This donation to other trusts is presently considered as application in full. That is, 100% of the amount donated shall be treated as application. However, this has been amended by Finance Act 2023 from April 2024 onwards. Only 85% of the donated amount shall be treated as application. This has come into the effect after various instances that have come to the notice that certain trusts or institutions are trying to defeat the intention of the legislature by creating multiple trusts and accumulating 15% at each stage. Now, by forming multiple trusts and accumulating 15% at each layer, the required application towards the religious or charitable activities has reduced significantly to a lesser percentage compared to the mandatory requirement of 85%.
Moving forward to our next amendment, that is currently new trust or institution under both regimes and under Section 80G regime need to apply for a provisional registration or approval at least 1 month prior to the commencement of previous year, and such registration or approval shall be valid for a period of 3 years. Similarly, provisionally registered or approved institution or trust under both regimes or under Section 80G regime will again need to apply for a regular registration at least 6 months prior to the expiry of provisional registration or approval, or 6 months within 6 months of the commencement of the activities, whichever is earlier, and the validity of such regular registration shall be for 5 years. The trust or the institution under both regime and under 80G regime again will need to apply for registration for renewal at least 6 months prior to the expiry of new regular registration. Thus, new trust or institution was required to apply for 2 registration, that too simultaneously if the activities has been already commenced.
The amended provision is that the trust or institution under both regime and Section 80G regime shall be allowed to make an application for the provisional approval only before the commencement of the activities. And similarly, the trust or institution which have already commenced their activities shall make an application for the regular approval. These amendments will take effect from 1st October 2023.
The next amendment is related to the exit tax under both the regimes. Trust or institution is required to pay the exit tax on accreted income within 12 months of the dissolution as per the Chapter 12 EB of the Act. Accreted income shall be the amount of aggregate of fair market value of the total assets reduced by the liabilities as on the specified dates. Such accreted income shall be taxed at the maximum marginal rate.
Now, it is proposed to amend the provision of Section 115 TD, which states that if the trust fails to make an application for the registration or regular registration within the stipulated time, then it shall be deemed to have been converted into any form not eligible for registration or approval, and accordingly, exit tax on accreted income would be liable to be paid by the trust or institution. Further, it has also been proposed that the principal officer or the trustee of the trust shall also be liable to pay the exit tax within 14 days from the end of the previous year. In the above provision, date of conversion shall be the last date for making an application for the registration, and these amendments will be applicable from 1st April 2023.
Presently, last date of submission of Form 9A or 10 is 31st October of the assessment year, which is same as of the ITR. And the last date of submission of the audit report in Form 10B is 30th September of the assessment year. Now it is further proposed to provide that the filing of Form 9A or 10 at least 2 months prior to the due date specified under Section 139 So the last date of submission of Form 9A and 10 would be 31st August of the assessment year with effect from 2023-24. Now, there is no change in the timeline of the submission of Form 10A.
Now moving forward to the last but definitely not the least amendment, which is related to the specified violation. If the application for the registration or approval or reapproval is not complete or contains any false or incorrect information, then it shall be considered as specified violation. There may be instances where the bona fide mistakes have occurred at the time of filing for the application of registration or approval. After the proposed amendment, it shall be at the discretion of the Principal Commissioner of Income Tax to treat such kinds of bona fide mistakes as specified violation or even may cancel the registration. However, in such cases, the charitable trust or institution can apply for the re-registration. Thus, we can conclude it by saying that years after years, the compliances are being levied on the charitable trust. And government is bringing more stringent compliances and pushing everyone to be very transparent and compliant.
This was all about charitable trust or institution and the amendments related to it. Further, in case of any clarification, you can reach through email address which is given in the description box.
Thank you for watching us. Please subscribe to the ASC Group.
Thank you.